Okay, let's take a look now at homework problem number 4 from chapter 10. This is depreciation. Now we've had an introduction to depreciation in chapter 4. What we're going to look at in chapter 3, this is an adjusting entry. And what we're going to look at now is the idea. We're going to look at this in a little more detail. And you've done this before. We're just going to add in one little layer of nuance. So depreciation is the expense that we use to account for the wearing out of a long-term asset, okay? Like a truck. The idea being we purchase a truck in year 1 that costs $62,000, and we're going to assume that it's a 10-year useful life. Now, useful life is basically an estimate of how long do we think we're going to use that truck. At the end of an asset's useful life, we're going to assume the asset no longer has use to us. So let the language guide you a little bit here. And just imagine a car or a truck in a business. At the end of 10 years, it really, truly no longer is able to operate as well as it once did, and we want to get rid of that and purchase a new car or truck to use in our business. Okay, that's the idea here. Now, depreciation requires these 3 data points or facts on the board here. We're going to have an initial cost. We're going to have what's called salvage value. This is new. We didn't look at this in chapter 3, but we're going to look at it now. And then we have this idea of the useful life. And this problem, homework number 4, asks us to look at computing straight line depreciation, meaning we're going to compute depreciation for this asset if we assume equal expense of depreciation throughout all 10 years of the asset. Okay, so let's unpack this a little bit. Visually, the idea is that we have a $62,000 asset. Over 10 years, we're going to use it, and over the 10 years, it's going to depreciate down to what we assume to be a value of $17,000. That's called salvage or scrap value. So the idea is at the end of the 10 years, we can no longer use the truck, but we can sell it for scrap. We can sell it to someone. They'll pay $17,000 for it. We don't know what they're going to use it for. Maybe they will kind of take it apart and use the various parts of metal, and maybe the tires will get repurposed. And this is kind of, by salvage value, we just mean what we can sell it for at the end of the 10 years, okay? It's important to point out here, we're dealing with some assumptions. We're assuming the useful life. The useful life would be assumed based on the asset itself. So as a manager, you would have guidance on what the useful life is. And then also the scrap value. So you'd have information that would inform some of these estimates. You're not asked to do that level of detail of analysis. For this problem, we are simply given these facts, and the question is, how do we work with the facts to compute the depreciation? So here's how it would work. We have $62,000. We want to depreciate over 10 years down to $17,000, which means we want to break this up into 10-year expense increments. Okay, that's ultimately what we're looking to do here. How do we do that? How do we evenly apportion this decreasing value over 10 years? Here's how we do it. Fairly simple formula. We take the cost minus the salvage value over the useful life. Okay? And we'll look at this formula. We'll do it real quick on the screen here. We're going to take the $62,000 minus $17,000. And think about what these numbers are showing. We are taking the value of the asset that we are using up, right? If we're going to get $17,000 of cash at the end of the useful life, okay, we sell it for scrap, let's say, to a junkyard or to a company that is in the business of taking a truck apart and being able to repurpose all the parts of the truck, then we don't want to depreciate the $17,000 value because we're not actually using that up. We're actually going to get a cash sum amount of that. Instead, what we want to depreciate is the amount 62,000 all the way down to 17,000. Okay, so that amount would be 62 minus 17 would be $45,000 divided by 10 gives us $4,500 of annual depreciation expense. Okay, so the $45,000 is the value kind of shown in this graphic up until year 10. Okay, that's the actual amount of the truck that we're using up, $45,000 worth of it. Because this is straight line depreciation tells us this $4,500 would be the even amount of depreciation each year. There are other methods of depreciation. We're not getting into that in this chapter, but it is in the text. Companies can depreciate more rapidly if they choose to, using, for instance, a method called double declining balance. This is straight line. It's the most straightforward. Take a crack at computing it on your end. You might have different numbers. Just know that this is the formula and this is how we would compute it. And know also these three terms. I just want you to have an introduction to these so that you have an ability to kind of work with these in the future if you see them either on the financial statements or in a business paradigm in one of your other classes. Okay, thanks.